America didn't suddenly become poor. It slowly became exhausted. Households are still spending, but not because they're confident, because they have no choice. Debt has replaced income, savings have disappeared, and every bill now arrives with less margin than the last. This is how collapses actually form. Not with panic. Not with headlines. But with pressure that builds quietly until the system can no longer absorb it. The most dangerous phase of an economic collapse is not the crash itself. It's the moment before it, when everything still appears to be working. Stores are open. Credit cards swipe. Jobs exist. Paychecks arrive. Spending continues. From the outside, the system looks functional. From the inside, it's running on fumes. This is where the United States finds itself now. The American economy has not stalled because people stopped consuming. It's weakening because consumption is no longer powered by income. It's powered by obligation. And that distinction changes everything. Nearly 70% of U.S. economic activity depends on household spending. Rent, groceries, insurance, utilities, transportation, debt payments. This is the engine that keeps the system running. When households are healthy, the economy can absorb shocks. When they're stretched, it becomes fragile. Right now, that engine is overheating. On paper, spending looks strong. Retail sales remain elevated. Nominal numbers climb. Headlines celebrate resilience. But those numbers no longer represent strength. They represent price inflation layered on top of financial strain. When prices rise faster than wages, spending totals can increase even as purchasing power collapses. Consumers pay more and receive less. The system appears busy, but it's hollow. A grocery basket that cost $100 a few years ago now costs $130 or $140. The register shows growth. The cart shows decline. Fewer items. Smaller portions. More compromises. This is not expansion. It's substitution. Consumers are not buying more. They're paying more to maintain the same baseline. And that baseline is becoming harder to hold. The difference between income and expenses does not vanish quietly. It must be filled. If wages don't cover the gap, something else does. For a time, that gap was filled by savings. Those reserves are gone. Now it's being filled by credit. Credit cards have become the shock absorber of last resort. Balances continue to climb, not because people are reckless, but because they're cornered. Minimum payments replace flexibility. Interest replaces momentum. This is not a temporary bridge. It's a structural shift. Debt was once used to smooth short-term volatility. Today, it sustains basic consumption. That changes the risk profile of the entire economy. Debt-driven spending is fragile. It depends on stability. Stable hours. Stable income. No emergencies. No interruptions. That is not how real life works. As debt replaces income, spending becomes brittle. It continues until it suddenly doesn't. And when it breaks everywhere at once. Savings once acted as a buffer. They allowed households to absorb price increases, job disruptions, and unexpected expenses without immediate behavioral change. That buffer is largely gone. Personal savings rates have fallen back toward levels historically associated with stress, not growth. Many households no longer have a meaningful reserve. Surveys consistently show that a large share of Americans cannot cover a modest emergency without borrowing or selling something. That matters because modern life is built on interruptions. Cars break down. Medical bills arrive. Insurance deductibles reset. Appliances fail. When savings exist, these events are absorbed. When savings don't, they force new debt decisions. Each decision reduces future flexibility. This is how households move from participation to survival. The system does not break because people stop spending. It breaks because spending becomes compulsory. Essentials crowd out choice. Discretion disappears. Every dollar is pre-allocated before it arrives. That shift doesn't show up immediately in data. It shows up in behavior. Consumers trade down. They delay purchases. They stretch payments. They reduce volume while paying higher prices. Discounts deepen earlier. Inventory clears only with aggressive promotions. Businesses feel this first in unit sales, not headlines. Revenue can look stable while demand weakens beneath the surface. When volume falls, margins compress. And when margins compress, cost-cutting begins. Labor is the largest cost. This connection is mechanical, not emotional. Companies do not wait for recessions to cut costs. They respond to pressure. They reduce overtime. Cut hours. Freeze hiring. Eliminate bonuses. Let attrition do the work of layoffs without triggering headlines. Employment remains intact on paper while real income erodes quietly. A reduction of just a few paid hours per worker across millions of jobs removes tens of billions of dollars from household cash flow. That loss does not disappear. It compounds. Wage growth does not offset this erosion. Nominal increases fail to keep pace with insurance, housing, utilities, and healthcare. Workers remain employed, yet feel poorer. The disconnect between official data and lived reality widens. This is where the illusion becomes dangerous. Because policy and markets respond to totals, not texture. As long as spending appears resilient, pressure builds to keep financial conditions tight. But beneath the surface, spending is no longer voluntary. It is reactive. It continues only because obligations must be met. The longer this persists, the more damage accumulates before recognition arrives. Debt expands. Savings vanish. Income thins. And fixed costs continue to rise together: insurance, housing, energy, food, healthcare. In past cycles, these pressures moved unevenly. Relief in one area offset strain in another. That offset no longer exists. Everything is rising at once. When fixed costs expand simultaneously in a system without buffers, discretionary spending is not reduced gradually. It is eliminated. At that point, the economy becomes dependent on one final variable: income stability. And that variable is weakening. Not through mass layoffs, but through erosion. Reduced hours. Lost benefits. Vanishing secondary income. Tighter performance thresholds. More output from fewer workers. This phase doesn't trigger panic. It triggers fatigue. Households adjust. They adapt. They survive. But resilience disappears long before activity stops. And once resilience is gone, the system becomes extremely sensitive to the next disruption. That disruption does not need to be large. It only needs to arrive. Because when an economy runs on exhausted households, timing becomes everything. And that is the position America is approaching now. The illusion of stability can last longer than expected, but once it breaks, it does not unwind gently. And the conditions for that break are already in motion. Once household resilience is gone, the economy enters a different phase. Not collapse. Not panic. But contraction driven by math instead of emotion. This is the phase where pressure stops being absorbed and starts being transmitted. When households lose flexibility, spending no longer responds to opportunity. It responds to constraint. Choices disappear. Behavior becomes defensive. And that shift propagates outward through the system in predictable ways. The first place it shows up is not unemployment. It's demand quality. Consumers still spend, but the composition changes. Essentials dominate. Discretionary categories weaken. Purchases that can be delayed are delayed. Purchases that can be avoided are avoided. This does not reduce spending totals immediately. Inflation masks it. Higher prices keep dollar figures elevated even as unit volume falls. The economy looks active, but activity is thinning. Businesses notice this before anyone else. They see inventory linger longer. Promotions deepen earlier. Clearance cycles shorten. Margins compress not because costs exploded overnight, but because pricing power erodes quietly. This is the moment where revenue growth stops being reliable. Companies respond the only way they can. They protect cash flow. Capital expenditures are delayed. Expansion plans are shelved. Hiring slows further. Contractors are released. Temporary roles disappear. Overtime becomes rare. Performance expectations tighten. None of this registers as crisis. Yet all of it removes income from households. That income loss feeds directly back into spending. The system operates as a loop. Reduced income weakens consumption. Weaker consumption pressures revenues. Revenue pressure tightens labor. Tighter labor reduces income again. This loop is mechanical. It does not require fear. It does not require sentiment. It operates automatically once thresholds are crossed. Financial markets routinely misread this phase. Asset prices can remain elevated because liquidity still exists. Earnings per share can be maintained through cost-cutting, buybacks, and accounting efficiency even as underlying demand deteriorates. Markets focus on appearances. The economy breaks on fundamentals. This divergence creates false confidence. Investors see resilience. Policymakers see stability. Meanwhile, households experience compression from every direction. Debt service absorbs a larger share of income. Minimum payments rise as balances grow. Credit utilization spikes. Financial flexibility disappears. At this stage, credit no longer smooths volatility. It amplifies it. As balances climb, lenders tighten standards. Credit limits shrink. Approval rates fall. The very tool that sustained spending begins to withdraw. This is when the slowdown becomes visible. Not because people stop buying overnight, but because the last artificial support is removed. Once credit tightens, consumption must align with income. And income has already been eroded. This alignment is abrupt. Spending freezes in categories that depend on confidence: travel, dining, durable goods, discretionary retail. Services weaken next. Employment follows later. By the time unemployment rises meaningfully, the damage has already been absorbed by household balance sheets. This is why downturns feel sudden even though they are built slowly. The recognition lags the reality. Public discourse always trails this process. Optimism persists because surface-level activity continues. Bills are paid until they aren't. Debt is serviced until limits are reached. The economy looks functional right up to the moment choice disappears. This is the danger of delayed recognition. Policy response also lags. Central banks react only once deterioration is undeniable. Rate cuts arrive after spending has slowed. Liquidity appears after balance sheets are weakened. These tools can stabilize markets quickly. They cannot restore household capacity instantly. Lower rates do not replenish savings. They do not reverse income loss. They do not lower prices that have already reset higher. This is why late-cycle intervention feels ineffective to households even when markets recover. The transmission mechanism is broken. Once spending depends on obligation rather than opportunity, stimulus loses potency. Relief does not translate into expansion. It translates into temporary stabilization at a lower level of activity. That stabilization is fragile. Because the underlying pressures remain. Fixed costs are still elevated. Insurance premiums do not fall. Housing expenses remain high. Energy and healthcare costs stay reset. Food prices stabilize at higher levels. Stability locks in damage instead of reversing it. Households adapt by lowering expectations permanently. They delay milestones. Homeownership. Family formation. Education upgrades. Long-term planning gives way to short-term survival. This behavioral shift matters. Economic growth is not driven by survival spending. It is driven by discretionary capacity. When that capacity disappears, growth potential contracts even if activity continues. At the macro level, this removes resilience. Small shocks that would once have been absorbed now propagate. A modest income disruption or price increase cascades into widespread pullbacks. The economy stops bending. It starts snapping. This vulnerability is invisible in headline data. GDP measures totals, not stress. Employment measures jobs, not quality. Inflation measures prices, not affordability. The metrics say one thing. Households experience another. That gap widens until behavior aligns everywhere at once. This is when contraction accelerates. Businesses that delayed adjustments are forced to act more aggressively. Layoffs replace attrition. Credit losses expand. Defaults rise in pockets that were already weak. Credit card delinquencies increase. Subprime auto defaults climb. Personal loan charge-offs follow. Lenders respond by tightening further. The loop tightens. Each stage reinforces the next. This is not panic-driven collapse. It is exhaustion-driven failure. Households do not suddenly stop spending because they are afraid. They stop because there is nothing left to adjust. At that point, consumption does not slow gradually. It stalls. In an economy where nearly 70% of output depends on household spending, a broad stall converts stress into systemic risk. Corporate revenues reflect the shift almost immediately. Volume declines accelerate. Earnings disappointments widen. Valuations reprice. Financial conditions tighten even without central bank action. Public finances absorb the next impact. Tax receipts weaken as consumption slows. Meanwhile, debt service costs remain elevated. Fiscal flexibility narrows precisely when support is demanded most. The system enters a phase defined not by shock, but by synchronization. Households cut back together. Businesses pull back together. Credit tightens together. What was previously staggered becomes aligned. This is the moment when the illusion finally breaks. Not with a single headline. Not with a single event. But with arithmetic. Income, debt, savings, and costs converge in a way that leaves no margin. The crash does not arrive because people panic. It arrives because the system runs out of room. And once that room is gone, behavior changes everywhere at the same time. That is the phase the economy is moving toward now. The final stage does not announce itself early. It reveals itself only after it has already taken hold. And that final stage is where this story leads next. When contraction reaches this stage, the economy does not collapse loudly. It fails quietly. Not through a single shock, but through synchronization, when millions of individual constraints align at the same time. That alignment is what turns stress into systemic breakdown. At this point, the economy is no longer adjusting. It is reacting. Households are no longer choosing where to spend. They are choosing what to delay, what to forego, and what to default on. Discretion has already vanished. Optimization is gone. Only prioritization remains. Bills are paid in sequence, not in full. Rent and utilities first. Insurance next. Debt service after that. Everything else waits. This ordering matters because it reveals how demand collapses without panic. Consumption does not disappear evenly. It concentrates around necessities and evacuates everything else. Entire sectors experience sudden air pockets. Travel stalls. Durable goods freeze. Big-ticket purchases vanish. Services dependent on discretionary income weaken rapidly. Small businesses feel it first because they lack buffers. Closures follow quietly. Not in waves, but in accumulation. A restaurant here. A retailer there. A contractor losing work. A service provider shrinking hours. Each closure removes income locally, tightening conditions further. This is how localized stress becomes national contraction. Credit accelerates the shift. As delinquencies rise, lenders respond mechanically. Standards tighten. Limits are reduced. Rates climb further for riskier borrowers. Access narrows exactly when dependence peaks. The last artificial support for consumption withdraws. Once that happens, spending must align with income immediately. There is no buffer left to soften the transition. This is when behavior changes everywhere at once. Households that were still spending out of obligation suddenly stop. Not because they want to, but because they must. Minimum payments crowd out everything else. Cash flow turns negative. Choices disappear. The economy does not slow further. It freezes. In a consumption-driven system, freeze is failure. Corporate balance sheets register the impact almost immediately. Revenue declines accelerate as volume collapses. Earnings misses widen. Guidance is withdrawn. Asset prices reprice rapidly once cash flows, not optimism, drive valuation. This is where markets finally catch up to households. But the damage has already propagated. Labor adjusts next. At first, companies tried to preserve appearances. Attrition, reduced hours, contractor cuts. That phase is over. Once revenue declines become persistent, layoffs follow. Not across the board, selectively, unevenly, but increasingly. Job losses further weaken income. Remaining workers face heavier workloads and tighter conditions. Fear enters late, not early. This is why crashes feel abrupt even though they are built slowly. Recognition arrives only after the system has already shifted. Public finances absorb the next shock. Tax receipts weaken as consumption contracts. Sales taxes fall. Income taxes soften. Corporate taxes decline. At the same time, obligations remain fixed. Debt service costs stay elevated. Social support demands increase. Fiscal space narrows precisely when intervention is needed most. Policy response arrives, but late. Central banks cut rates. Liquidity expands. Financial conditions ease. Markets respond quickly. Households do not. Lower rates do not restore depleted savings. They do not reverse income loss. They do not reduce prices that already reset higher. Relief stabilizes markets before it reaches people. This creates a dangerous disconnect. Asset prices recover faster than household balance sheets. Confidence returns at the top while exhaustion persists at the bottom. The economy appears to heal while behavior remains constrained. This is how recoveries stall. Without household capacity, stimulus leaks into asset inflation rather than real expansion. Growth becomes shallow, uneven, and fragile. This is the lasting damage of exhaustion-driven collapse. The system survives, but smaller. Households permanently lower expectations. Discretionary capacity does not fully return. Risk tolerance remains suppressed. Long-term planning gives way to caution. This changes the structure of demand for years. Businesses respond accordingly. Investment remains conservative. Hiring stays selective. Expansion is delayed. Productivity gains are prioritized over headcount. The labor market stabilizes at lower intensity. Wage growth remains subdued. Job quality recovers slowly, if at all. The cycle does not reset cleanly. It recalibrates downward. This is why crashes defined by exhaustion, not excess, take longer to heal. There is no single bubble to reinflate. There is no rapid rebound in confidence. The damage is distributed across millions of balance sheets. That damage does not disappear with rate cuts. It fades slowly, as households rebuild savings, reduce debt, and regain flexibility. That process takes years, not quarters. History shows this pattern clearly. When consumption collapses because households are exhausted, recovery is constrained by behavior, not policy. Spending does not surge back. It inches forward cautiously. Growth resumes, but below potential. This is the cost of running an economy on debt instead of income, on obligation instead of choice. The crash itself is not the most damaging event. The aftermath is. Because it reshapes incentives, behavior, and expectations long after headlines move on. The defining feature of this phase is recognition. Denial ends not with panic, but with arithmetic. When income, savings, credit, and costs all converge at their limits, behavior adjusts everywhere at once. The system does not break dramatically. It gives way under its own weight. That is why crashes are always obvious in hindsight and invisible in advance. They do not announce themselves early. They reveal themselves only after resilience is gone. The conditions for that reveal are no longer theoretical. They are structural. Household exhaustion. Debt substitution. Savings depletion. Income erosion. Fixed cost compression. These forces are already aligned. The outcome is not guaranteed, but the margin for error is thin. And in systems built on consumption, thin margins matter. Because when households can no longer absorb pressure, the economy no longer bends. It breaks. Quietly.